Welcome to Breaking News to Trading Moves. Imagine running a business, right? And you have to stand up in front of your investors and admit, well, you missed your current revenue estimates.
Yeah, and actually lost money.
Right, actually lost money. But then, in the exact same breath, you confidently promise that you will make even more money than expected by the end of the year.
It sounds like a total contradiction, but that is exactly the headline we are looking at today regarding Hims and Hers Health.
It really is a financial paradox. I mean, when a company posts a surprise loss but raises its full-year guidance, the math has to be changing somewhere behind the scenes.
Exactly. Something is moving under the hood.
So we have gathered a stack of earnings reports, market commentary, and financial data for you. And our goal is straightforward. We want to figure out the mechanics behind this specific earnings report and identify the clear winners and losers as a business model evolves.
Right, because Hims and Hers is transitioning away from lower-cost, compounded GLP-1 weight loss drugs.
Yeah, they are.
And instead, they are moving toward branded FDA-approved treatments, specifically Wegovy, through a partnership with Novo Nordisk.
Okay, but before we talk about the trade-offs of that move, we really need to clarify what a compounded drug actually is. Because, well, that is the entire crux of their current margin structure.
Yeah, it really is.
Please explain it, because I think a lot of people just assume a drug is a drug.
Right, that makes sense. So when a branded drug like Wegovy or Ozempic is officially listed as being, quote, in shortage by the FDA, federal regulations allow specialized compounding pharmacies to legally mix custom versions of those medications.
Okay.
They source the raw active ingredients, in this case semaglutide, and they create a custom batch. And because they're basically bypassing the massive research, development, and branding costs of the major pharmaceutical companies, well, these compounded versions are incredibly cheap to produce.
Oh, wow. So platforms like Hims and Hers have been taking advantage of this legal loophole. They sell a compounded version to the consumer at a lower price than the branded pen. But because their acquisition cost is so low, their profit margin is just incredibly high.
That is the exact mechanism, yeah. The compounded drugs act as a high-margin cash engine, but, it comes with a ticking clock.
Right, because of the shortage status.
Yeah, once the FDA declares the official shortage is over, that legal loophole closes. The compounding pharmacies just have to stop making it entirely.
Which brings us back to the headline. Hims and Hers is getting ahead of that ticking clock by pivoting to the official branded Wegovy.
They are, and they secure long-term credibility that way, but the economics get completely flipped upside down.
How so?
Well, the transition brings immediate margin pressure. Branded drugs cost them dramatically more to acquire. Then you factor in the legal costs of negotiating these partnerships and the restructuring costs required to handle branded pharmaceuticals. Ultimately, it just creates a much tougher, narrower path to actual profitability.
I mean, think of it like a local coffee shop that roasts its own beans. For years, they control the entire supply chain. They buy cheap raw beans, roast them, and sell a cup of coffee at a premium.
The profit on every single cup is fantastic.
Exactly. But then, to attract a different tier of customer and secure their reputation, management decides to stop roasting their own beans and exclusively sell bottled Starbucks Frappuccinos.
Right. Suddenly they have total brand credibility.
But Starbucks now dictates the wholesale price of the product. The coffee shop's profit margin on every sale practically vanishes, and they probably have to buy expensive new commercial refrigerators just to meet Starbucks' display standards.
Yeah, the daily operations become infinitely tighter and more expensive to maintain. The credibility goes up, but the underlying economics become a tightrope walk.
And as we look at the broader market, this event highlights very clear winners and losers across the board. We are talking about obesity drug trades, digital health platforms, telehealth valuations, and pharmacy distribution.
We really are.
So let's start with the winners. The first group reclaiming pricing power and distribution are the branded drug leaders.
Yeah, because platforms are forced to move toward branded FDA-approved drugs, the immediate beneficiaries are the companies that actually own the patents and manufacture those specific treatments.
Makes sense.
The pricing power leaves the digital platform and returns entirely to the creator of the physical product. So Novo Nordisk benefits directly through the Wegovy partnership.
And for those following along, that is ticker NVO for Novo Nordisk.
Yes. And we also look at Eli Lilly, trading under LLY. They remain a primary competitor with major obesity and diabetes drug exposure.
Right.
These manufacturers dictate the wholesale cost. They do not need to negotiate favorable terms with telehealth platforms because, well, consumer demand for the branded product is already sky high.
But I have to challenge this a bit.
Okay, go for it.
If I am a patient and I know I have to get the official branded Wegovy pen, why do I need a trendy digital health app at all? Like, why wouldn't I just go to my regular doctor, get a prescription, and walk into my local pharmacy to pick it up?
You are identifying the exact vulnerability the market is pricing in right now.
Oh, really?
Yeah. As regulatory pressure makes the compounded models less viable, patients naturally seek the most legitimate, established access points for FDA-approved treatments. And this hands a massive advantage to established distribution platforms.
So we're talking about the traditional retail and pharmacy giants.
Uh-huh.
Companies like CVS Health, Walgreens Boots Alliance, and Amazon.
Exactly.
And for those tracking, that is CVS, WBA, and AMZN.
Those companies benefit from prescription fulfillment and broad consumer health distribution because they already have the infrastructure built.
Right, the physical stores?
Stores, yes, but also cold chain storage. GLP-1 medications like Wegovy are peptides. They require strict temperature control.
Oh, I didn't even think about the refrigeration.
Yeah, CVS and Walgreens have commercial-grade refrigeration in thousands of locations. Amazon has an entire logistics network optimized for it. A digital startup trying to distribute branded drugs either has to build that physical infrastructure from scratch or pay a premium to rent it from someone else.
So the wild frontier of online medicine ends up relying on the legacy retail giants just to get the physical product to the customer's door.
Pretty much.
The traditional companies have a home field advantage because they already laid the concrete years ago.
That infrastructure is a massive barrier to entry. But, the drug makers and the pharmacies are not the only winners here.
Who else?
As the market for these treatments becomes more formal, highly regulated, and incredibly expensive, a third group of winners takes control: the healthcare gatekeepers.
By gatekeepers, you mean the managed care and services sector, right?
Yeah.
The insurers and the pharmacy benefit managers.
That is exactly who I mean.
So we are looking at companies like United Health Group, Elevance Health, and Cigna. That is UNH, ELV, and CI.
Yeah. And to understand why they win, you have to look at the mechanics of how a pharmacy benefit manager or a PBM actually operates.
Okay.
They do not manufacture the drug, and they do not prescribe it. They just sit right in the middle, managing prescription drug benefits on behalf of health insurers, Medicare Part D drug plans, and large employers.
Break down the actual mechanism for us. How does sitting in the middle translate to immense market power, especially with costly drugs like GLP-1s?
It all comes down to the formulary, the official list of covered drugs.
Okay, the approved list.
Right. Let's say a branded weight loss drug has a list price of $1,000 a month. The PBM goes to the manufacturer, like Novo Nordisk, and says, "We control access to 50 million patients. If you want your drug on our approved formulary, you have to give us a $400 rebate."
Wow, and Novo Nordisk agrees because they just need the volume.
Exactly. The PBM collects that rebate, passes a portion of it to the health insurer, and keeps a cut for themselves.
It is like a toll booth operator on a major highway. But instead of just collecting a flat fee from the drivers, the toll operator negotiates secret payments from the car manufacturers just for the privilege of allowing their specific brand of cars to drive on the road.
That is a great way to put it.
And because the toll operator decides who gets through, they hold all the leverage.
Exactly that. Furthermore, these companies utilize tools like prior authorization.
Right, the dreaded paperwork.
Because GLP-1s are so expensive, the insurers want to limit how many people actually get them. So the PBM forces the doctor to fill out extensive paperwork proving the patient meets very strict medical criteria before they will agree to pay for the branded drug.
So they control the guest list, they decide who gets past the velvet rope, and they negotiate the entry fee behind closed doors.
That is the reality, yeah.
And as consumer demand for these treatments grows, but payers push back on the costs, the administrative scale of companies like United Health or Cigna allows them to absorb the friction far better than any smaller player could.
They turn cost management into a revenue stream. So we have established that the manufacturers, the physical distributors, and the financial gatekeepers are positioned well. Now we have to look at the other side of the equation.
The losers.
Yeah.
Which brings us back to the digital health margins under fire.
Right.
Hims and Hers is the direct short-term loser here, as evidenced by that surprise earnings loss. The market is openly questioning their customer economics.
Yeah, when we evaluate digital health platforms, the entire business model relies on a very specific mathematical formula: customer acquisition cost versus lifetime value.
The SAC versus the LTV.
Exactly.
Let's explore that math for a second, because if I am paying a monthly subscription fee for a telehealth app, doesn't the platform make money as long as I stay subscribed?
Only if the cost to service you is lower than your subscription fee.
Okay, fair.
Let's look at the customer acquisition cost first. Telehealth platforms spend heavily on marketing television commercials, podcast ads, social media campaigns just to get you to download the app and sign up.
That upfront cost is really high.
It is.
And the lifetime value is how much profit they make off me over the months or years I actually stay on the platform.
Correct. When they were selling compounded drugs, the math worked beautifully.
Because it was cheap.
Right. The drug cost them almost nothing to acquire, so a large portion of your monthly fee was pure profit. It paid back the marketing cost quickly.
Okay.
But now, switch the product to branded Wegovy. The drug costs the platform hundreds of dollars to acquire. Suddenly, your monthly subscription fee barely covers the wholesale cost of the medication, let alone the doctor's time, the software maintenance, and the initial marketing money they spent to acquire you.
The platform effectively turns into a loss-making drug distributor. I mean, they are passing the branded drug along at cost, or maybe even at a loss, just hoping you stay subscribed long enough for them to figure out how to monetize you later.
And investors are becoming highly skeptical of that strategy.
I can see why.
We see this pressure extending beyond just hims and hers, too. It applies to other major digital health platforms like Teladoc Health, ticker TDOC, and ticker AMWL.
So basically, any telehealth company carrying heavy marketing spending and relying on expensive third-party drug fulfillment is facing brutal margin compression.
Exactly.
And it also hits consumer weight loss platforms, right? Companies that built entire business models around consumer demand for weight management. We're looking at WW International, formerly Weight Watchers, trading under WWN, and LifeMD, ticker LFMD.
Yeah, those companies face an existential dilemma regarding customer retention.
Tell me more about that.
Well, think about it. If a user signs up for a weight loss platform specifically to get access to GLP-1s, what happens when their insurance denies the prior authorization? Or what happens when the platform has to raise its monthly subscription fee just to cover the rising wholesale cost of the branded drug?
I assume the user just cancels the app and goes directly to their primary care doctor instead.
Exactly. The churn rate spikes. The predictability of the subscription model just vanishes.
Because they don't control the product.
Right. You want a low fixed cost to service each user. But when the primary product your users demand is a highly regulated pharmaceutical controlled by Eli Lilly or Novo Nordisk, you are entirely at the mercy of their pricing decisions.
This sets up the final consequence we really need to talk about today: the profitability penalty. The scrutiny we are seeing on hims and hers reveals a much harsher market reality for the entire sector.
It does.
Investors are losing patience with high-growth healthcare companies that lack a clear, immediate path to actual profitability.
For a long time in the tech and digital health space, growth was the only metric that mattered. The strategy was to operate at a loss, acquire millions of users, and just figure out the profit margins later.
The classic Silicon Valley playbook.
Exactly. But the reaction to this earnings report tells us that growth alone is no longer enough. A company can raise its revenue guidance, promise more sales, and the stock will still sell off sharply if the margins are eroding.
I have to ask, though, Amazon operated at a loss for years to build scale. Uber burned billions of dollars to capture the market. Why can't digital healthcare technology do the exact same thing? Like, why is the market punishing them now for a strategy that clearly worked for other tech giants?
Because the underlying product is entirely different.
How so?
When Amazon operated at a loss, they were using the money to build physical warehouses and lock in a logistics monopoly. They were building a permanent moat.
Okay, that makes sense.
But digital health companies operating at a loss are mostly just spending capital on Facebook ads to acquire patients for a drug they do not own, do not manufacture, and do not control.
So the infrastructure is not a moat. They are basically just middlemen renting access to someone else's product.
Exactly. And when investors realize the moat does not exist, well, the rotation happens quickly. We see strict scrutiny placed on high-growth healthcare stocks across the board. Companies like Oscar Health, ticker OSCR, and Clover Health, ticker CLOV.
The market reality is a rotation away from names where profitability is continually delayed. I mean, if a business model relies on regulatory changes remaining favorable, like hoping the FDA keeps the compounding loophole open, or if the margins are completely uncertain, investors are simply taking their money elsewhere.
Uneven earnings invite strict scrutiny. The lesson here is that it does not matter how much consumer demand exists for a product category.
Right.
Everyone knows the demand for weight loss drugs is astronomical, but if the companies delivering that product cannot actually capture and keep the profit from those sales, the sheer volume of revenue is irrelevant to the health of the business.
Let's bring all of this together for you. We started by looking at a confusing earnings report from Hims & Hers Health, a missed quarter, a surprise loss, but a raised revenue forecast.
Right.
And what the data reveals is a massive transition in the industry, moving away from cheap, compounded alternatives and toward branded, FDA-approved treatments transfers market power entirely.
It hands the leverage over to the established pharmaceutical manufacturers who control the patents, the legacy retail pharmacies who control the physical cold chain distribution, and the insurance gatekeepers who dictate the financial flow.
Meanwhile, it severely punishes digital platforms that are burdened by high customer acquisition costs, heavy marketing spends, and delayed profitability. The rules of the game are evolving, and the legacy players are the ones equipped to handle the heavy infrastructure demands of branded medicine.
The digital startups acted as incredible marketing engines to build the initial consumer awareness. But now that the product demand is established, the traditional giants are capturing the actual economic value.
It leaves you with a critical question to consider as you watch these specific markets evolve and track these companies moving forward. Can consumer healthcare startups ever truly scale profitably when their entire business model relies on distributing highly expensive, branded drugs that are completely controlled by someone else?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.